This is a fairly common question we get on a lot of these webinars, almost regardless of the subject is, what are the common mistakes that we see? We're doing this all day, every day. What are the common mistakes we see about insurance? The biggest one is I've got cover in my super fund. I don't need to look at this. That's partly because the government has mandated that all super funds offer a basic level of life and TPD cover to all of their members. In fact, it's a prerequisite for getting the My Super stamp of approval, which allows the fund to be a default fund for an employer. It's great for the 20-25% of the population who can't get direct personal cover because of their occupation, health, or recreational activities. So if you're a cell phone tower technician and you climb 50-meter towers, you're going to struggle to get cover. If you're a underground miner, or you work offshore on the rigs, they're really tough occupations to cover. If you've had some very significant health issues, you may not be able to cover it. And so your super fund acts as an insurer of last resort, and that's really good. No taking away from that. Once you move up from that default cover, it can actually get quite expensive. If you look at it compared to buying widgets, you say, look, they're big buyers, they should be able to get a cheaper price. In practice, because they're more likely to have a poorer quality risk pool, they may actually be more expensive. And especially when you move up from the default level of cover. So Australian Super, for example, really cheap, basic level of cover, but that level of cover is next to useless for most people. So if you step up to a level of cover that does actually cover off the risk, that's not going to cut the mustard. So that's step number one. Step number two is the distinction between all those things I just spoke about. Once you're in the system, they can change the rules. That doesn't apply to group cover. So group cover or default cover in your super fund is a contract between the super fund and the insurance company. And that will change when the super fund goes out to tender. And of course, the super fund has an incentive to keep the price down, even at the expense of quality, because most consumers are incapable of assessing the quality of that cover. The quirks as to how you define TPD, that's the skill of being a good advisor, to be able to understand those. Some of them are quite legalese, and it's really tough. So most of the super funds, when they want to please the ratings agencies, they want low price default cover. So Australian Super, a few years ago when they changed insurer, they changed the definition of disabled very much for the worse. Now, I'm not picking on Australian Super specifically here. When Rest moved their insurer either to or from AMP, I can't remember which way around it was, anyone who wasn't employed on the day suddenly lost a cover. So that level of change can happen. You may or may not get pre-existing conditions covered when they change insurer, and usually the level of cover is insufficient. So most people think, oh, I'm in a super fund, I've got cover. Usually it's inadequate and it's an inferior product and maybe more expensive. So it's always worth reviewing. The other one I see is, I'm young, it won't happen to me. And the great other thing about this underwritten cover is that the younger you are, the cheaper it's going to be, and the less the risk that you've got a medical history that's going to stop you getting it. So getting in early is a big plus. There's a feature called guaranteed future insurability, which may allow you to increase that cover later on. Getting in early is really good. And the other one I see is, what about the NDIS? What about work cover? Isn't that going to solve this problem? And the answer is, the NDIS, despite the term National Disability Insurance Scheme, will not put a cent in anyone's pocket. It's designed to pay for services, not to put food on the table or keep a roof over your head. Hugely expensive, great benefit to many people, but it's not going to replace your income. Work cover obviously only covers events that happen at work. Generally, it's not going to cover a lot of things. It's designed to get you back at work and rehabilitate you. Similarly, car accidents, the TAC in Victoria in particular, isn't there to keep you going to retirement. And then the other interesting one is, we often see people with employer-paid cover, particularly salary continuance cover, which covers 2 years, that covers off the first 2 years. But what about the next 40 odd years? So it might be free or provided at a discount rate, but you might need to supplement the 2 years with another policy with a 2-year wait period, or you might lose the policy when you leave. So some of those policies have the ability to replace it with a personal policy if you do it within a very tight window. Some of those windows have a requirement that you're employed at the time within that window. So if you leave to go travel over Europe, you may not be able to replace it. So they're probably the big mistakes that I see.